Hi, I am Hitesh Jain, and as part of the Global Financial Literacy Week, today we are going to discuss on commodity and currency markets. So before we begin our deliberation on how to track commodities and FX markets, it is quite important to understand the interlinkage between various asset classes, and you cannot look at a particular asset class in isolation, because given the interlinkage, the variables which influence commodities also influence FX markets and for that matter the equity markets. It is indispensable to understand the dynamics of all the asset classes to get a broader holistic view in terms of your asset allocation. For instance, if you look at the equities, the overall equity outlook of a particular market is clearly influenced by commodity prices. For instance, you look at Indian equities are predominantly influenced by oil prices, given that the country is a large importing nation in terms of the oil requirements. Similarly, you look at Chilean equity markets, they are influenced by copper prices because it is a major exporter of copper, and given that the majority of revenues for the country come from copper exports, copper prices to an extent influences the overall economic and the equity outlook of that market. Similarly, if you look at the currency market, a stable FX markets generally influences or prop equity valuations of a country, while a volatile currency dissuades foreign capital inflows. In terms of how to track commodity and FX markets, I would state that if you need to track commodity and FX markets, the job itself demands an acumen of an economist, because one has to adopt a top-down approach. So the price trajectory for commodities, if you look at, just not hinges on the supply demand fundamentals, but it also influenced by the global macroeconomic dynamics. Now, if you look at industrial metals like copper, aluminium, zinc, lead, despite the supply demand balances, it is influenced by what is happening in China, because China is the major consumer of all the non-ferrous metals, where literally 45 to 50% of all the non-ferrous metals is consumed by China. So if one looks at copper, one has to be abreast with what is happening in terms of the underlying economic trends in China, in terms of how their industrial production is going on, how their fixed asset investment is going on, what is their industrial policy, what is their environmental policy, whether they are curbing steel output, whether they are curbing iron ore output. You have to keep a tab on all these things. So it's a top-down approach. So you have to look at the macroeconomic side, and then you have to come down what is the equation in terms of the supply-demand gap for the particular commodity. What eventually drives prices is the gap. So to make it in a simpler terms, when I look at copper prices, I would look at what is global supply for a particular year and what is global demand for that particular. The gap between the supply and demand influences prices. The wider is the gap, the bullish are the prices. When I mean the wider the gap means if the supply is lagging behind demand, that means that particular commodity is in a wide deficit. The higher the deficit, higher are the prices. The lower the deficit or surplus, generally the price outlook will become too benign, or the prices may not move higher. If you have a wide surplus, that means if the supply is more than demand for that particular commodity in that year, the markets will try to factor in this the evolving supply demand variables, and as a result you're going to see soft prices, or prices are going to move lower. This equilibrium basically applies to all the industrial metals. In terms of oil, which is also an industrial commodity, we also look at the supply and demand side of the equation. But more than the demand side of the equation in terms of oil, which is generally stable. So apart from a huge disruption which we saw during the COVID times, where you had big dislocation of demand, otherwise the demand outlook is very much certain. What is more variable is the supply side of the equation, especially in oil markets, because the vagaries of the geopolitics in the Middle East The supply side of the equation for oil is very fickle because you may have a deteriorating political situation in the Middle East, or you can have a war in Middle East which can influence or disrupt the supply, and that can lead to a big spike in oil prices. So for oil markets, when I look at the equation, I focus more on the supply side rather than the demand side. If you talk about other commodities, let's look at precious metals. Gold is an interesting commodity. Although we talk it as a commodity, we talk it about as a commodity, I don't look gold as a commodity. I look at gold as more of an alternative currency, given that it is always deemed to be a hedge against the eroding purchasing power of the various fiat currencies. So if I have to look at gold, I always look at how the monetary policies of the various central bank evolving, whether they are printing more money, how's the fiscal situation of various governments evolving, are they printing more money. So when they print more money or the central banks expand their balance sheet, that means more injection of monetary supply, it is naturally going to lead to inflationary expectations. And higher inflationary expectations tends to boost gold. So if you look at history, gold generally is influenced by two factors. Either you have a disinflationary backdrop or you have a hyperinflationary. In normal times where you have normal inflation, gold does not perform well. It is either you have extreme events, either you have a global recession which leads to disinflation, or you have on hyperinflation, gold tends to rally. As I said, that it is more of a hedge against the eroding purchasing power of fiat currencies. So when you move on to the currency markets, you have to be kind of a macroeconomist, because when you look at currency markets, as there are a lot of factors which are overlapping when you look at commodities and currencies. When I look at a particular currency, so for instance, if I look at US dollar, I would certainly look at, as I mentioned, that how much, the variables which are applicable for gold, the same variables to an extent are also applicable for currencies. So for USD, I would look at the fiscal situation, how the trade evolving, either the country has a positive current account balance or a negative current account balance. What is the overall balance of payment of the balance of payment situation, the political situation, and there are various other factors in terms of how's the interest rate outlook, because there's always money always flocks to a higher yielding instrument. For instance, if the interest rates are moving lower in the US and relatively they are higher in other developed economies, for instance, the interest rate gap between Germany and US is widening or is narrowing, it influences the capital flows. If you Fed means the Central Bank of America reduces interest rate and the European Central Bank does not reduce the interest rate, it is more lucrative to park your money in your European denominated instrument rather than investing in a US dollar denominated instrument. So the interest rate outlook, the fiscal outlook, the trade outlook, the global political situation influences the overall currency outlook. Similarly, for the EM currencies like India, as I mentioned, there are factors which influences how foreign portfolios flowing in the equity markets, in the debt markets, how is the political situation, how are the reforms taking place, how is the investment policy, whether the government is open to investment into the foreign direct investments in various sectors, how is the economic growth, because the higher the economic growth, the prospects of higher inflows are very much there for a particular currency. So we have discussed the various dynamics which can influence commodity and FX markets, and also the interlinkage of the various variables between the commodity and FX markets, and also these factors has an influence on a broader market like equities and debt markets, given the fact that we are also talking about the interest rate outlook. So if we consider these variables and we look things from this perspective, it can give you a comprehensive understanding in terms of the medium term and the long term outlook of the mentioned asset classes. I hope this understanding makes you take informed decision in terms of your investing. Thank you very much.